I'm very pleased to be here. I'm usually based in Beijing, and I co-lead the Tech Metals Consulting in APAC alongside with a colleague in Sydney. So I'll start off. The lithium, cobalt, and nickel markets have faced the EV disruption heads-on since 2015 and 2016. The evolution in these markets has since been driven by the speed at which supply is able to ramp up. Supply has shaped and will continue to dictate these markets over the medium term. So the world is gathering pace for the greening of transport and power, and these are the two mega trends in commodities today. It first started with power generation, with the increasing adoption of renewable energy since the 2000s to cut greenhouse emissions and also capping the growth of fossil fuel consumption, especially in coal. Transportation is next, with the shift into EVs to cut tailpipe emissions, which is particularly important in improving air qualities in cities and reduce the consumption of petrol. And the EV megatrend started in 2014 to 15. So the EV revolution has fundamentally, So the EV revolution has changed fundamentally many of the commodities markets. The EV share of demand is increasing rapidly across many commodities. So on top, I've got lithium, cobalt, nickel, and natural graphite, and the share of EV demand between 2017 and 2022, and they're growing rapidly. The greening of the economy will also affect other commodities like aluminium and copper, which are not used in the batteries, but are used in the vehicle itself and in the charging infrastructure. And EVs will be a key demand driver for these commodities. However, the mining industry as a whole saw a structural decline in investment prior to 2014 and 15. And the lithium and cobalt market prior to the EV revolution was relatively small and stable, and cobalt production was hampered by low nickel and copper prices. So with a lack of mining investment across the industry as a whole and the uptake in EVs, it means that these markets was unable to anticipate the huge demand surge caused by EVs. So on the chart on the right, you can see that because of these shortages, prices really spiked. So starting off with lithium in 2015 to 16, cobalt in 2017, and nickel in 2018, to reflect these price spikes reflect market tightness and a fear of continued supply shortages. So price increases encourage new supply. So the chart on the left shows the annual supply growth in 2016 and 18, which are in double digits compared to the annual increase in supply volumes between 2010 and 2015, which are less than 4% across the three commodities. So price spiked, increased supply responses. And in 2018, we saw that the increase in supply volumes in cobalt and lithium overshot demand and pushed these markets into surpluses. In cobalt, mine production increased so faster than anticipated, with production at the mine level from tailings, from the additions of cobalt circuits at existing byproduct mines. And at the chemical level, we saw Chinese cobalt sulfate capacity ramping up much faster than previously expected. So for cobalt, there's no shortage of supply at the mine level and at the chemical level. And we estimate the market surplus was over 9,000 tons of cobalt in 2018, which is about 8% of demand. In lithium, project commissioning and expansions at existing suppliers also pushed the market into a surplus, around 24,000 tons of lithium carbonate equivalent, so around 9% of demand. In nickel, the story is a bit different. So prices only increased towards the end of 2017 and in 2018. So supply hasn't been able to respond fully to the price spike. And in 2018, the market was still in a deficit. And we expect more price support as more supply is needed in the market. I think this is the juiciest slide. So across lithium, cobalt, and nickel, there are challenges, but there are also opportunities. So I'll go through them one by one. In lithium, the challenges are associated with producer expansions of the ramping up of greenfield mines, the expansion of existing producers. So these can add significant volumes into the market. But there are also opportunities. Downstream integration is a key trend that we've been seeing. There's more automakers, cathode makers are interested in securing equity stake or offtake agreements with producers of miners and brine producers. In the market, there's demand for high-quality lithium compounds of very high purity to go into battery making for EVs. Especially the requirements from the Japanese and the Koreans are very stringent, and very few or none of the existing producers can produce at the ideal grade that is needed. There's also a need for a non-Chinese supply of lithium compounds. So we are seeing the construction of lithium compound facilities in Australia, and that is really to meet the demand for non-Chinese supply. So these are the opportunities that exist in the lithium market. So what should the miners do in lithium? It's still so in the period of excess supply and falling prices, to ensure that the cost of production is low, to have a partner to work with in the downstream so that they are locked in to your product in terms of quality and in terms of volume, and in the collaboration you have with each other in the certification of your product through the downstream value chain. Miners should review their marketing strategy and market positions. So at different development stages or different stages of production, what's your priority, what's the future, what's your next steps? In terms of prices, so the spot Chinese lithium compound prices has continued to fall, and we expect this year that some high-cost, non-integrated conversion facilities will be pushed out the market because they're buying at market price instead of buying their raw materials at cost. In cobalt, as mentioned, supply is unconstrained at the moment at both the mine and the chemical level, but excess supply causes a price fall. That's actually good for demand. So the lower cobalt prices will delay the substitution into 811 high nickel, low cobalt chemistries, because the need to move towards a high nickel content was partly driven by cost, and the cost pressure is no longer present. So lower prices are good for demand. In terms of opportunities in cobalt, so clean cobalt certification is rare. There are very limited supply outside of the DRC, and for cobalt coming out from the DRC, it's very hard to ensure it's actually clean. So there's a need and a premium for non-DRC, non-artisanal mining cobalt. And you can ensure that by having the process outside of the DRC. So what should the miners do? I'll mention low-cost production again. I think being a miner and trying to ensure you are low cost is natural, but previously, because the market was so good and prices were so high, maybe cost of production wasn't a key priority, but getting the material into the market was. But now, with the market adjusting and supplier responses being so rapid, then ensuring costs and low-cost production is very important. And as a miner, you have to watch out for the way your downstream off-takers and customers are behaving. So the flexibility of refineries, your customers, in producing, having the ability to produce metal and sulfate is important. So last year, the price of metal increased so rapidly was because most of the production was geared towards the chemical use, and that resulted in a shortage in metal. So in China, some of the refineries are having this capability in switching the ultimate product mix to meet the market demands. So if your customer has this ability, then they are protected with their margins. For prices, we believe the price of cobalt will recover in the medium term as destocking exercise comes to an end, and then price needs to support the cost of production. The long-term challenge in the cobalt market is in recycling, which will hit the market from 2025 onwards, and that's a real risk. In nickel, the challenges are with the development of Indonesian HPAL potentials. So these are the development of nickel used in the battery space through laterite ores. The opportunities lie in potential delays of these projects. Previous HPAL projects were very high capex and opex, and kind of estimates were overrun, and there were delays. So if there are delays, it will limit the time and the volume of additional nickel supply coming into the market, and that will create opportunities for additional supply to come into the market. Miners should also watch their cost, but then the HPAL developments in Indonesia will be higher cost than current production, and mostly will be above current price levels. So actually, the commissioning and the success of HPAL projects will also give support to nickel prices. And finally, there's growth in both the batteries demand for nickel as well as stainless demand. So stainless demand will grow at a slower rate, but it's healthy. And to conclude, I'd like to take you back to this slide on EV sales forecast. I think a lot of you sees it, but we forecast around 2025 as continued technology developments in batteries will push EV prices, the cost of EVs, below that of traditional vehicles in absence of subsidies globally. So you can see there's a real uptake of EVs after 2025 at a rate which is much higher than what we've seen already. So the greening of energy and transport, that transition is already underway, and it will continue to impact the metals market. And I think for everyone, all to play for. Thanks.